So we learned some powerful momentum indicators, some oscillating indicators that can be really, really good. And you might be asking yourself, okay, what's the difference between an RSI and the stochastic oscillator? What's the difference, and is there a better time when I should use one or the other? And that's what we're going to talk about in this lesson. So first off, let's talk about their similarities, because it's more similar than different, actually. So with the stochastic oscillator and the relative strength index, they are both widely used. So they're both widely used. They're both very, very popular. They're both momentum oscillators. So that means it's going to be between 0 and 100%. So they're all going to be percentages, and they're all going to be positive numbers. They're really looking at these overbought and oversold situations. That's what we're trying to identify as we get closer to peaks and troughs of overbought and oversold securities. And they're simple to use. They'll simply, you can just choose your parameters, or just choose it, and it'll overlay the graph, and you can just watch for the, as we learned in the previous lessons, you can watch for the conditions, the buy and sell signals. And they're really good to use to confirm with other indicators. So if you're using something else as your primary indicator, a candlestick pattern, a chart pattern, maybe a moving average, whatever it might be, these oscillators, these stochastic oscillator and relative strength index, are good to use to kind of confirm what you're seeing. So really what the big difference is, and how we might apply that, is under the underlying philosophy, which gets into the math, which gets into the calculation. Again, you don't have to calculate on your platform, but if you think about it philosophically, this is where the difference comes in. The stochastic oscillator is predicated on the assumption that closing prices should close near the same direction as the current trend. So if you've got an uptrend, you should have uptrending closing prices, and that close should kind of close near that same direction, or in that trend. So it emphasizes that trend part of the closing prices. This RSI is designed to measure the speed, the acceleration or the deceleration of price movements. They both kind of do that a little bit, but RSI, that's really all about speed. That's really where it shines, and where its strength lies as far as in that. So the key is which to use when. Is there a strength of one over the other? Well, they're both actually very good in what they do. That's why they're so similar. So it's more the similarities. But if we were to nitpick and say, well, if we were to really say, oh, okay, what's the best for each of these, versus they're both good in any of these types of markets, as an oscillator, as a momentum indicator, a stochastic oscillator tends to be best for choppy or sideways markets. Where there's no great trend identification. There's nothing great where you've seen a trend be identified, because it's trying to help identify, or it's kind of helping you decide whether it's overbought or oversold, and there's not a clear trend. And so if it's used in a strong trend thing, sometimes that can cause a premature exit. Let's say if you're in a strong upward trend, and it's accelerating, the stochastic might not show that as much, and you might exit a little bit sooner with a stochastic oscillator. As opposed to, let's say, the relative strength index, which is really great for trending markets. Is it accelerating that trend? Is it keeping getting strong? Or is it decelerating that trend? And that trend could be either up, an upward trend, or a downward trend. But it's really great for those markets. Now, as we saw in the lesson RSI, it can also help reduce the choppiness and things of whipsaws that a standard momentum, the basic ROC, or rate of change momentum indicator uses. But if we were, and that's why stochastic oscillators and relative strength index are both, I would say, better than the momentum indicator overall, depending on how you use it. But that's just an opinion at that point. But the RSI was good for identifying and taking you out of that less trading range too. So this is, again, all real kind of nitpicky stuff, real kind of detailed stuff around it. But I would say certainly if you've got a market that's really trending strongly, or trending and you're working a trend, I would definitely tend to rely on that RSI. Stochastic oscillator can give you those false signals in those trending areas. So really the big takeaway from this is, if it's a strong trend either way, use the RSI.